Well, good afternoon, everyone. Hopefully, folks will join us. It's 2 minutes after 3 o'clock, so I think we should get started, and hopefully folks can join us as they come on. So first of all, I want to thank everyone for joining us this afternoon. We have a number of people on the webinar, and so welcome to BankingBook Analytics free webinar series. My name is Andy Poprawa, and I'll be hosting the webinar today, along with Sohail Farooq, my colleague. We're going to record this with your permission. So welcome again, and we're going to be talking today about enhancing profitability at credit unions, the alignment of strategy with risk, which is a very big topic. We're going to leave the mics open, so if you feel that you'd like to stop and ask a question along the way, please do so. And as I mentioned, we're going to record this session so that other folks that couldn't make it today will join us and listen in and watch the series as we go through it. So with that introduction, I'm going to pass it over to Sohail, who's going to give us a little bit of a backgrounder on BankingBook Analytics. Over to you, Sohail. Want to change the slide? Thank you.
Thank you so much, Andy. Hello, everyone. My name is Sohail Farooq. I am CEO and founder at BankingBook Analytics. BankingBook Analytics essentially is a risk and capital forecasting firm. We specialize in developing risk and capital forecasting applications using statistical methods and machine learning. We assist financial institutions with specific focus on mid-sized FIs. So that could include really the smaller banks, credit unions, insurance firms, and so forth. So our work is divided in two cohorts. The first, as I said, is the development of the applications. The second is the consultancy, where we work closely with our clients in terms of assisting them based on their current situation with regards to the data and develop decision-making systems and so forth. So with that as the introduction, I would like to actually briefly talk about the background of putting this topic out. As you know, that disruption risk is evolving and is emerging for almost every sector in financial services. And its manifestation is different. For some of the financial services cohorts, this risk is specific with regards to cutting the costs. For some others, this is more pronounced, and there could be several reasons why it is more pronounced. We would not be going into the reasons behind it, but this presentation talks about the disruption risk, the sources of the disruption risk, and how we can assess and develop a framework to understand the severity of this disruption risk. And finally, we would also be talking about what quick actions we can take to be able to mitigate the disruption risk. And with that as the background, our focus has been how do credit unions sustain the profitability levels and the capital adequacy levels going forward. So that is really at the heart of this presentation.
Great, thank you, Sohail. And by way of introduction, my name is Andy Poprawa. I'm the past CEO of the Deposit Insurance Corporation of Ontario, where we're the regulators for Ontario credit unions, and I've also been involved at OSFI, and before that, I've run a credit union. So delighted to be with you this afternoon. So here's what we're going to cover this afternoon in the presentation. Please, as I mentioned earlier, please feel free to ask questions along the way. Just jump right in, and we'll be happy to address them as we go through. So in terms of the executive summary, we're going to talk a little bit about Sohail, if you could just change the slide there. Thank you. We're going to talk a little bit about regulation. As you all know, the trend line is straight up on terms of regulation. More direct regulations, increasing oversight by all the international, national, and provincial regulators. Definitely more assessments through inspections on site and overall supervisory approaches. more of a risk-based system, and more pressure on institutions to put in place a lot of the international regulatory and supervisory frameworks that regulators have asked us to do. And that really speaks to the issue that pushing down the responsibility for oversight, risk management, generally to the institutional level. In addition to all that, of course, the competition, not just from banks, but also from new fintechs, startups are gaining a foothold in Canada. They've been around Europe and North America generally for quite a while. And then that's leading us to a situation where the margin business that credit unions have lived with for a long, long time is now giving away to some extent to the volume businesses that these new fintechs are hopefully going to gather in terms of their strategies. We also, with respect to risk, the nature of the risks have changed as well. And obviously the regulatory bodies as well as the institutions are really looking and focusing more on the risk management and risk assessment functions throughout the organization. Enterprise risk management is pretty much a standard these days across the system. And these other new risks that are coming along, cyber risk, climate risk, all those new ones that are emerging over the last little while have emerged, are becoming harder to quantify and deal with. And finally, the number one issue that seems to be on minds of everyone today in today's marketplace, especially given the last 10 years, is liquidity costs, liquidity risk. This is becoming an issue for a number of credit unions as they try and grow. The one we'll be talking a little bit about today is business models and the alignment of those business models. The access to capital markets, of course, for credit unions is quite limited. In the context of making sure that they have capital sources, which is essentially their members, or the ability to be able to build their own retained earnings at the time. And clearly more focus on digitization and automation of various processes within the organization. And finally, on this particular slide, we talked a little bit about the increased consolidation. We're seeing that more and more, especially in places like Ontario, British Columbia, and other jurisdictions. We're seeing much more consolidation within the credit union, and that's not to be discounted, because that's certainly a huge issue going forward, especially for those credit unions that are operating in a very broad geographic region and area. And in some cases, credit unions have decided to move into the federal regime and operate across Canada as federally regulated institutions. So moving on to the impact assessment of all that. So there's three sort of lenses, and disruption can have a significant impact on credit unions, obviously. There's the impact on the business model, which, as I mentioned just a moment ago, we looked at in the context of traditional business models that are now changing, more focus on non-interest revenues of some sort or another, which are going to help build capital over the long term. The impact on members and stakeholders overall, both the communities and the individual members. And then finally, the impact on the types of business that the credit unions are undertaking. So all these things are coming together. And then so the question then becomes is what actions need to be taken? And you know, more and more, as you are probably doing in your credit union, more and more credit unions are looking at their strategy. I'm actually doing a strategy session with a credit union right now. We're talking about refreshing the strategy, looking at what needs to be done over the next 5 to 10 year period to build out the core competencies and capabilities. Obviously, looking at protecting the revenue base as, again, the market becomes more competitive. Cost cutting's been around for quite some time, but now I think it's becoming more important as one of the primary features of improving profitability. And of course, managing the balance sheet, making sure that whether assets are staying on the balance sheet or being moved off through some kind of securitization or other processes is being done in a thoughtful way. So meeting the disruption challenges requires a number of linkages, and these linkages relate between strategy, risk, and finance. So the next slide will show us a little bit of how we think that's going to interplay. One of the things that credit unions ask me to talk about with them is, what's good growth and what's not, and how do we identify those good growth options? Obviously, one of the principal issues to talk about is the risk appetite. And this is owned by the board and the chief risk officer in all credit unions. The idea here is, how much risk should we take? What's our risk capacity? Those kinds of questions. And how do you monitor those risks given what's going on around us? And then the capital management, which is typically owned by the CFO and the audit committee. How much capital do we need to take those risks on? Back to this whole issue of risk capacity. And then finally, the strategic planning process, which is typically owned by the CEO, but obviously the board has a significant input into it. And the question really there is, where should we place our bets? What's the market product mix that best fits the needs of our membership, as well as ensuring sustainability for the credit union going forward? So moving on then to looking at the fluidity, and I'll just pass it over here to Sohail to chat a little bit about this issue.
Yes, so I think the key message that comes out here is that what kind of information or what kind of intelligence is needed really to make such decisions. And was this information available historically to the incumbent credit unions, or this information needs to be developed from scratch? So, of course, if you look at really the current sort of metrics that are in place, such as return on assets or return on equity or some of the other metrics, we find that these metrics may not really be able to provide the kind of answers that the stakeholders want. So with that as the background, the question then becomes, what kind of information is required by the CFO to make such decisions, and what kind of information would then actually be rolled up to the CEO? So those are important questions, and to address those questions, what we would like to do is share with you some of the key corresponding metrics that are available within the risk framework. And that really is also a precursor to understanding that where should we place our bets, and what is good growth really. So to answer those questions, we have identified some principles that would enhance the fluidity. So for example, the key question is, do we understand the questions that emerge from various stakeholders? What kind of decision-making framework or structure should be in place at credit unions? And where should we start? What is the minimal acceptable risk that we can actually take on books? And how do we quantify that? And the benefits of course, doing this type of communication and creating internal structures would be that you would have better transparency in place. There would be a clear standard across which all transactions can be measured, monitored, and be able to assessed. This would also remove the kind of overlap or remove the bureaucracy. Of course, there are some overlaps that would stay or should stay between the C-suite, but there would be clear boundaries, and that would allow more efficient decision-making processes. And finally, it would also provide you with the kind of levers that you need to implement those decisions. So a good example is risk appetite. Understanding risk appetite from the perspective of a strategic lever is extremely important, because risk appetite would allow you to expand the risk or basically shrink the risk. So these are some of the examples that we have identified in the subsequent slides. So here we're looking at some of the key takeaways from our sort of refresh the strategy, balance sheet management, and the kind of action plan that we talked about. And we've identified some levers that are available with the leaders within the credit unions. And for example, the key lever that we're looking at is a balance sheet growth. And what are the enablers of the balance sheet growth? From a risk perspective, the enabler is really the capital adequacy. How much capital do we have? Is this capital adequately optimized? So in other words, are the risk weights that we are taking on books are punitive and eating away or consuming our capital? and what kind of loss forecasting we can create. So that would really refer to tools such as ICAP or scenario-based stress testing. And then from stakeholders' perspective, the question then becomes, what is our risk-bearing capacity? Um, are there any early warning signals that we can develop, and how we can implement or embed those early warning signals? And finally, what kind of return are we generating? Is this return adding value or accreting our capital or creating our capital, or is this merely an accounting return? And what kind of value this return is providing to the stakeholders? And finally, how we can cut the costs and create a decision analytics where there is minimal interference from, say, underwriters in terms of loan adjudication. And it is really to the extent of where risk-based adjudication becomes important. So those are some of the key levers and the drivers behind them, which, of course, come to the point of what kind of capabilities we can generate. Andy, you want to talk about it? Hello?
Especially the smaller ones, is that eventually you run out of capital, and when you run out of capital and or liquidity, then your days are numbered, and you have to start looking around for other options in terms of your business planning and processes and membership. And at the end of the day, I think it's really important in Canada at least, and elsewhere as well, but Canada in particular, that we have sustainable small institutions that can challenge the banks in terms of service. And as we saw the results of the annual assessment of how financial institutions do in terms of service to customers, members, Credians again hands down beat the banks. So the banks may be making more money, but the service levels aren't what they should be. And I think that's really what the government's policy is to make sure that small institutions survive, thrive, and are sustainable in the future.
For sure, yeah, and I think that risk-adjusted return on capital. With that curve you presented, I think we definitely, especially on the riskier end of it, I think we are not charging that that gap there between risk-based pricing and.
Totally agree. Totally, I've seen so many instances where, a commercial loan has been shopped around, and they eventually end up at the Credian because the Credians are eager to take that risk on their books.
Yeah.
Because it's a healthy margin compared to the last mortgage you did, but you could probably charge a heck of a lot more if you wanted to, because that's what the market would bear.
Yes, exactly. Well, and to find out kind of in the next recession, kind of what your underwriting standards were, right?
Yeah.
And how they've fared, because everyone's tempted to kind of cut corners or to accept those higher returns kind of when times are good, but then once there's a downturn, you gotta find out what you have on your books. Yep.
Stay tuned. We're not that far away, I think.
Yeah, I know.
Okay, so yeah, let's move on, because I think we're gonna be up against the time pressure shortly.
Okay, perfect. So as we said, looking at what is available within the credit union system and what applications can be developed is extremely important. Now, that of course is a function of their current capabilities with regards to the risk analytics. So what we've done is we've taken one example here. BBA also has, as I said in the beginning, we develop risk and capital forecasting applications. So we also provide an IFRS 9 software that really allows credit unions to develop pricing using the expected credit loss metric. So that is a great example in terms of how available risk analytics can be used to be able to determine the pricing framework. There is, of course, additional parameters that are required, one of them being the risk-based capital attributed to each transaction. Nonetheless, some simplifications and benchmarking can be done on that level. But that being said, this is a good schematic of what is it that can be accomplished. Now, going back to Josh's point, here we're also looking at fee income. That is not purely the interest income. Similarly, we talked about the fund transfer pricing or FTP, and then the risk parameters that would govern. And in the end, it gives us the expected loss and both the unexpected loss. So, and then finally, we can use the tool to determine the risk-adjusted return or RAROC. And this can be done at the portfolio level and also at the transaction level. A good example from that perspective.
That's great. Thanks, Sohail. So another key component of this whole discussion is all about risk appetite and the limit setting. So I think we're going to move into that area now. If you want to proceed, Sohail, we can move to the next couple of slides. There we go. Go ahead.
Right. So I guess when we talked in the beginning as to what overlaps exist between the CEO, the CFO, and the CRO, and what risk constituencies they represent. Now, of course, from a CEO's perspective, the idea is that where should we place our bets? From CRO's perspective, the idea is that how do we accept the risk? And from the CFO's perspective, the requirement is that how much capital do we have? But at the same time, what is important is that if we look at the outside-in perspective, from a stakeholder's perspective, is that what are their requirements and what is it that they're looking at? Now, this entire process begins by defining the stakeholders and identifying their demands, and then putting it all together, because now we have expanded the horizon and we are not just looking at the internal view, but we're also incorporating the external view. And really, a document that assembles these views in a succinct way is called the risk appetite. Now, of course, there are metrics, there are measures, there are limits that can be added to that. But that being said, risk appetite is really a document that brings together the requirements of various stakeholders and how they're being balanced within the organization. From regulators' perspective, their requirement is that a credit union remains solvent, is able to pay its depositors, is compliant with the regulations. Similarly, from a creditor's perspective, they would like to know that is there sufficient capital buffer that exists? And management's job is really to balance these stakeholder demands. And then from a risk versus return perspective, the members want to know, is this the good growth that we are having? How do we avoid the surprises? And then finally, how do we manage the downside risks? So those are some of the things that sort of are all clubbed together in risk appetite, and they're really the building blocks of putting together a risk appetite statement. Andy, would you like to add anything from a regulatory perspective?
Well, I think you've covered it all. I think the issue there really is the difference between capital adequacy and capital efficiency is really the key point here. Two different, multiple stakeholders, of course, on the regulatory side, certainly about capital adequacy, protection of the depositors is key for them. They, the regulators generally don't really care about capital efficiency. They care to the extent that it creates a sustainable credit union, but they don't really care about whether you're using a capital as efficiently as possible. But their primary focus, obviously, would be capital adequacy. Thank you.
So I guess this brings us to a point where we're looking at the traditional performance measures and we're mapping them with the risk-based performance measures. So as we said in the beginning, that from traditional performance measures, of course, the storyline looks great. The growth has been tremendous. But from a risk-based performance measures, what does it mean? And then what are those risk metrics that need to be developed? So we talked about RAROC, economic value add. Some of the other examples are risk-adjusted return on risk-weighted assets. That is also extremely important performance measure, and it belongs to the same family of the risk-based risk-adjusted performance measures. Similarly, the historic view of looking at the loan book versus the prospective or the sort of the futuristic view of the loan book is becoming increasingly important. IFRS 9 is a step in that direction, and I guess the ICAP, the Mertens models, and scenario-based stress testing are some of the things that are also coming into to aid the decision makers in credit union systems. So I guess what we wanted to do also as a result of this webinar was that we wanted to provide some key takeaways as to how to put together risk appetite statement, right? So risk appetite is a key driver and a lever in terms of implementing and embedding the strategy within the organization. So of course, it starts from the top, but it gets integrated from the bottom as well. In other words, the objective is that these statements or the headline requirements are issued by the management, but at the business unit level, they are embedded and implemented. So really, it is important that an integration is there, and the metrics and the limits which are set out by the risk appetite are implemented. We have seen financial institutions using risk appetite lever as the driver of expanding or contracting the risk acceptance within the organization. So really, a lot of strategic implications can be implemented through the risk appetite. So that's really the beauty of this particular document. So these are some of the building blocks. As we said, there are some possibilities of quick wins. One of them is the strategic heat map and developing early warning signals as a result of the heat map. So looking at the heat map really brings together two important concepts. The first and the foremost is the frequency, and the second is the severity of the risk occurrence. And I think from that perspective, it becomes important that we also identify the concept of materiality and proportionality, because there could be several risks that are out there from risk identification perspective, but are they material to your organization? Are they proportional with respect to the activities that the organization is performing? Are also two important lenses that need to be kept in mind. So an ICAP exercise allows credit unions to formulate their approaches for the risk appetite. And of course, the key building block there is a risk heat map. And finally, this is a case study slide that allows really from the perspective of what sort of risk expansion is available in various various business lines. A good example is that looking at the concentration risk. Now, concentration risk and its measurement is, of course, quite challenging. A standard measure which looks at the concentration risk is Herfindahl index. We also develop concentration risk capital requirements based off of the ICAP work that we do. But the idea is that where is it that you can add additional risk on the books? So this gives you an idea that, as more and more diversified portfolio and the capacity where it exists and how you can add it. Now, where you see all the reds are clearly marked as early warning on this heat map. And of course, these are the risks which are concentrated, need constant monitoring and vigilance to protect and mitigate against those. Andy, any thoughts on that?
No, I think you've covered it well, and this would be sort of something that is the next level of risk, enterprise risk management from most credit unions. I think a lot of credit unions have done some basic work on a heat map with respect to their major risk areas, but it's not terribly, my experience again, not terribly strategic necessarily. And I think this is a sort of next evolution, next step in the whole idea of trying to figure out where the risks are in terms of the various buckets and how they all interplay with each other. So a good example of what the future might look like for enterprise risk management on the strategic level.
So I think from a wrap-up perspective, we're looking at the key benefits of increasing the fluidity between risk and finance. As we said, risk is the holder or custodian of important information that would allow finance to make even more informed decisions. That would also allow the CEO to cascade these decisions using risk appetite. And as we said in the beginning, the key benefits are creating the standardization across the board in terms of acceptance of the risk and providing a consistent measure with regards to the return associated with each risk. Now, credit unions can, of course, look at it from the perspective of by increasing their the incumbent information and adding additional risk metrics in terms of the analytics. So some examples that we've shared with you today are development of the RAROC, understanding the early warning signals that are associated, putting together a risk appetite dashboard. So those are some of the examples that we think, and this outlines here that what partnerships can be developed internally between risk, finance, and the strategy. Yeah.
So that's.
Well, thanks you guys for that.
Yeah. Happy to answer any other questions people have or comments or any other topics you want to raise. Happy to engage in that conversation. So if you have any, let's talk about them now. I should, while you're thinking about that, I should mention that the next webinar will be on November the 12th at 3 p.m. And we look forward to hosting it again and having some people participate. So happy to answer any questions or comments.
I see Hank has his mic on, and I've done a lot of talking. So Hank, do you want to go?
Yeah, it was interesting, gentlemen. It was interesting, somewhat helpful. So do you, as your business analytics company, do you use software that analyzes these risks, or? Huh?
Sir.
Hello.
Yes, we are here, Hank. Could you please repeat your question? I think there was some slight interruption.
Yeah, on one of your later slides, you were talking about software that you were using to analyze this risk framework. So is that are you marketing that, or?
Yes, indeed. We are marketing that. We are Andy can talk a little bit about the work we are doing with credit unions. And of course, a lot of our work is really aimed at developing capabilities and the credit union system, allowing developing such analytics. Yeah. We have a formal catalog of our products that we can share with you.
Mm-hmm.
Yeah, I was going to say, why don't we do that, Sohail?
Yeah.
We have been working with a couple of credit unions, engaging with them on developing a more sophisticated model that they currently have in IFRS 9, as well as the kinds of things we talked about today. So happy to give you an idea of what those models look like and what we could do to help credit. You know, from my perspective, in my practice in engaging with BankingBook Analytics and Sohail and his colleagues, it's really all about trying to help credit unions get more profitable, better understand how to make money, and become more sustainable. And I think that's, from my perspective, that's our goal. And that can be done in many ways. In some cases, you don't need a complicated or sophisticated model. In others, it's good to build that model and build on it as the data becomes more available. So I think that's some of the sort of discussion points and areas we want to focus on going forward. Does that help?
Yeah, that helps.
Just had a question around, you had mentioned some quick wins, which I thought was a good way to phrase it. And I think you mentioned earlier on getting value from regulatory data requirements. And Andy, as I'm sure you know from working as a regulator, the scope of these data requirements. So I'm in credit risk, and those in BC, and those have continued to just escalate, and it seems like they'll just keep continuing to do that in the future. So you know that takes a lot of FTE time, and so in terms of getting extra value out of that, I think you highlighted some ways there, but just I don't know, in terms of other ways or actions that can be taken off of the information that regulators are asking for, you know, just kind of how to get more value out of it rather than just regulatory compliance, you know.
An excellent point, Joshua. And you know, from my perspective, one of the key elements of gathering data is to be able to provide it back to the credit unions on a sort of aggregate basis, so that you can see what's happening not only in your credit union but how that relates to others. I know in several jurisdictions, credit unions have gotten together through their central or independently and shared data with other credit unions just for that purpose of being able to aggregate data and look at any trend lines that might be valuable to explore. So, you know, each jurisdiction has had a different, you know, modus operandi, and in some cases, the large credit unions have got together and done that as well. So, you know, my encouragement to you, if there are mechanisms in the province that you're operating in, to pursue those and certainly engage with the regulatory bodies. And I've done some work with FICOM and QDIC and BC, for example, on this issue of sharing the data and trying to make sure that credit unions are able to use that data to the extent possible to build models individually and aggregate and collectively that would make you know, be helpful. Obviously, the more you can do together, the better off you are, because typically credit unions in most jurisdictions are not competing head-to-head directly. They may be competing in certain markets, but not head-to-head.
Right.
Sorry, go ahead.
Oh yeah, no. So they're very cooperative. I think we do. There are some information sharing initiatives with credit unions in BC of kind of similar asset classes. So yeah, that's good.
You have the peer groups going still, right? As I recall.
Definitely. Yeah, in terms of, I'm just thinking of, you know, say you get a whole bunch of information that say you've never compiled before, but now you need to because of your regulator. You have something like the heat map there, or early warning signs. Is that a way to kind of, so, you know, provide it to our regulators, and then maybe versions of that also make it to senior management and boards and things like that, who also want to see what our regulators are asking for. But then they just see the information and say, okay, this is what we're, you know, where our book is at a point in time. This is our different portfolio segments and whatever else that regulators ask for. But then nothing else happens after that, right? So would you kind of suggest, kind of from what I've seen with these early warning signs and heat maps of like, okay, here are areas for opportunity, or, you know, to do more basically than just look at it and say, okay, this is what our book looks like, and that's it.
Well, absolutely, you know, and this is you know, it's a bit of a chicken egg thing, right? Because until you build the models until you put the data in the models and start drawing some conclusions, you don't know what you have. And so, the ideal scenario is, to make that investment. And I think it is an investment. There's no question, both in terms of, resources, money and time and people, and education, because I think training and development of your staff is critical to this, because once you start doing this, you start understanding the business better, and then you understand the risks better, and then you understand the outcomes better. And I think that, from that perspective, I think it's a great opportunity for credit unions to take the next step. Banks have been doing this, and Sohail can tell you, for years, and the results have been very positive. So I do think that there's an opportunity here to move to the next level. But again, you have to convince the senior folks in your credit union to make that investment and to take it seriously. And once that happens, and educate the board and senior management about what all this stuff means. Well, I do think there's tremendous opportunity here to develop a higher degree of sustainability.
What is to your point about the getting senior management buy-in? What is the story you would tell them to get that engagement, to make that investment?
Well, the story, my experience has been, the story is that, how do you know whether you're making money in the things that you're doing? Because a lot of times it's all, 5 years ago, we made this decision to get into commercial lending, for example, and we're making money. Well, how do you know?
Yeah.
To your point earlier, once through a business cycle, how do you know? Because you may have been making money for 4 years, but the last year was a disaster because there was a recessionary period or whatever, and it's not that great. So, and how do you know whether your risk appetite is the right risk appetite? And how do you know your risk tolerances and capacities are the right risk tolerances and capacities? You don't know that until you start modeling and stuff.
Yeah, Josh, may I ask if you've started with NBC, if you started with ICAP reporting already, or is it something that is on agenda for 2018? Remainder of
yeah, I believe they've had some version of ICAP reporting for a while now. So you're using that to mitigate concentrations and things like that.
Right.
But I don't think we have that depth of insight into kind of like that RAROC calculation, right. Which I think would be good for us in terms of being able to charge the right risk premium
right.
for what we're. So I think I think we're doing an adequate job on defense, if you will, but in terms of actively pursuing opportunities, I think that's where there's lots of room for growth.
Understand. Is the business makeup changing? I mean, we've been hearing stories that from a strategic perspective, credit unions are, of course, now focusing more on enhancing the relationships with their existing customers. And this is, of course, one area where the banks are shrinking their investment, and it is opening up an opportunity. You've got robo-advisors that the banks are putting in place and so forth. And, this is opening some space for credit unions. How is it that the strategic focus is altering in the credit union world from a business perspective?
Well, okay, so in terms of, I'm not sure on like the deposit side or the investment side, but in terms of the lending side, I know there definitely is space opening up there in terms of small businesses, because I know that's a segment they usually don't want to touch, but there's definitely room in there. And it's usually, it's kind of, we have to deal with whatever the banks focus the least on, I guess. That would be kind of our, and to your points earlier about just being able to generate a certain amount of capital. Like you need a certain amount of size to be able to get into certain market segments. So I think we've been doing things with syndication as well, to get into some types of lending that we wouldn't normally otherwise. So I think that's another way for credit unions to grow as well, either in partnership with each other or through their central, like you're saying. So those are some of the ways.
In terms of securitization, now, of course, this is a question for everyone on the call today. In terms of securitization and the warehousing of loans, Your current access point is really Central 1. Is there an expectation that that could change in the near future and you can access the debt capital markets directly?
I don't know much about that. I think that's more of a, I guess that'd be a treasury question. But yeah, I'm not aware of any plans.
I could give you some color on that. That's highly unlikely in the short term. It might be something going on in the longer term, but I think in the short term, definitely going to be going to Central 1.
Okay. Yeah, no, I think that those are some excellent comments and feedback.
So in our next session, actually on November the 12th at 3 o'clock, we're going to be talking in more detail about ICAP and crafting a business strategy around that using the ICAP analytics. So I think it's going to be another interesting conversation.
Yeah, for sure.
So tell your friends.
Yeah, a disappointing turnout for today.
Yeah.
Well, why don't we wrap it up then? If there are no other questions or comments,
that's fine.
Wrap it up and thank everybody for joining in today. It's a bit over an hour, so I think we want to be respectful of your time. And we invite you again to join us the next time around. We'll be sending out a notice on that, right, Sohail?
Yes, indeed.
Yeah, thank you, Sohail. Andy, it was good.
Well, thank you, and thank you for joining us. Much appreciated.
Thank you.
We'll sign off now and wish you all a great day, and we'll see you on the 12th.
Thank you.
Thank you. Bye-bye.
Bye.